In Chapter 2, again, we're looking at trying to build your foundation of cost accounting. To do this, we have to know a lot of definitions. These definitions will come in handy in our future chapters, so you might want to make sure you fill out this information and keep it handy to make it a quick reference back when we come across these topics again. You'll notice a lot of these definitions might be familiar to you, or hopefully they are, but we're going to start introducing some new concepts. So make sure you pay careful attention to some of the newer concepts. One other thing I want to review with you is the cost flow process for cost accounting. We always start with our product costs. These are our direct materials, our direct labor, and our overhead. They get assigned to jobs. This then goes to our work in process account. After that job is complete, then we transfer those amounts to our finished goods. Remember, while our product is sitting in these three accounts, it is an asset to our company. It's not until it gets transferred and sold does it move to our cost of goods sold and become an expense. So all of these labor costs, the cost of our materials, are considered assets until they are sold, and then they become that expense. Some of that should have been a review, and if it's not familiar or if it's been a while, please make sure you review some of those 5-minute videos to get yourself up to speed on some of those topics. I do want to go through with you an example from our homework for this chapter as we start to talk about and really identify some new concepts. And one of those new concepts revolves the difference between variable or absorption costing and looking at the difference between the profit, gross profit, and contribution margin. So I'm going to start off with this problem. Again, you can find it in your book, and there's also a practice problem with different numbers in Blackboard. So this is exercise 2-52 and 2-53. And it just gives us some very simple information. What we need to do is dissect this and kind of pull it apart for use in our financial statements. So looking at this information, the first item that they want is our variable costs. We can go through and highlight anything that is a cost and a per unit we know is a variable cost. But what we want to determine is the difference between a manufacturing cost and a variable cost. And in this first question, in A, they want the variable cost per unit. So to get that variable cost per unit, I'm just adding up all variable costs. So if I add up the 21, 12, 24, and 5, I get a total variable cost of 62. Now you'll notice the difference in this one. This is a variable manufacturing cost per unit. So because of that, I want to make sure I take away anything that is not a manufacturing cost. So looking at the variable manufacturing cost per unit, I'm only looking at the 21, the 12, and the 24, which equals 57. In C, this should be a new concept for most of you. They want to determine the full absorption cost per unit. When I'm looking at the full absorption cost, that means I want to consider everything that's going into this product, which means I have to consider this fixed cost. But we have to put that on a per unit basis. So if I want that on a per unit basis, I'm going to take the 135 of my total fixed manufacturing cost and divide that by the number of units I've made. If I do that, I should get $4.50. I will then add that to my costs to determine my full absorption cost per unit. Again, this is looking at just how much is it totally taking me to make this product. So I would include the 57 that I just did and that 4.5. So that would equal a total of, if I do my math right, $61.50. Now the difference, notice, in this is the full cost per unit. In the full cost per unit, we are also including our other fixed costs. Here is the rest of my fixed cost. Again, I have to put this on a per unit basis. My total fixed marketing and administrative costs were $117. I have 30,000 units that I produced and sold, and therefore it's $3.90 per unit. So under that full absorption costing, I'm going to take the manufacturing costs that I came up with, everything there, and I'm going to bring in everything that it takes to make this product. So I'm going to start with that 57. I'm going to add in that $5 other variable costs, but I'm also going to add in the $4.50, and I'm going to add in the $3.90. So this is the full cost per unit, and the total is $70.40. So now we want to look at what is a gross margin per unit. Our gross margin per unit is going to take into consideration the sales price and then also the full cost per unit. So that's why we needed all of this information to start with. So when I look at, let me change colors here so it's a little bit easier to see, your profit margin per unit, that's going to look at your sales minus your full cost. If I do that, I can see my sales cost per unit, $79, minus my full cost that I just determined was $70.40. And therefore that profit margin is going to be $8.60. Let me erase that there so we can see that. Now let's look at our gross margin. So first we did our profit margin. Now we're going to look at our gross margin. The difference in your gross margin is your sales minus your full absorption costing. So again, my sales price was $79. My full absorption costing, which I can find in C, is $61.50, leaving me a gross margin per unit of $17.50. And finally, let's look at that gross or the contribution margin per unit for G. So this was E, this is F. We're going to look at G. G is that contribution margin per unit. And if you remember, contribution margin is sales minus variable cost. So here, again, I start with the 79, and I'm going to subtract out my variable cost per unit from A, which is 62, which is going to give me a total of $17. That contribution margin is going to come in very handy when we get to the other chapters on cost, volume, profit. The second part of this is now using this information and looking at the difference between a gross margin income statement and a contribution margin income statement. So let's look at those now. In your gross margin income statement, let's see if I can, we'll change colors here so you can see the difference. We'll just make it a little darker. And we're going to look at this income statement for the gross margin. For gross margin, you're looking at sales. Then we're going to take out our variable manufacturing cost. I'm going to have to start abbreviating or I'm going to run out of room. Then we'll take out our fixed manufacturing costs. To get me that gross margin. Then I'm going to take out my variable selling and admin costs here. So my variable marketing and admin cost. And then my fixed marketing and admin. And so what this is doing is just really kind of breaking out for you what is that product making, and finally taking out those administrative costs to give you that operating profit. So let's take a look at the numbers here. Our sales, well, we know that we're selling each of these for $79 per unit, and we sold 30,000. So if I do that math, it comes to 2,370,000. Our variable manufacturing costs, we looked that up. We know from doing our work up in the previous problem that our variable manufacturing costs are $57. We made 30,000 units, which gets us to this 1,710,000. Our fixed manufacturing costs are given to us. They're right there, the 135. I subtract my sales from my costs to get my gross margin of 525. Then I'm going to pull in my variable marketing and admin costs. It was $5. We had 30,000 units, so that's 150. I'm going to bring in those fixed costs of 117. This is just given to you, giving me that operating profit of $258, which is just your gross margin and subtracting out those variable and fixed admin costs. And finally, let's look at the difference in what it looks like for that contribution margin income statement with those same pieces just put together a little bit differently. So my contribution margin income statement. How does this look different? First, remember contribution margin, we follow through with that. It's sales, and we're going to subtract out all of our variable costs. So we have our variable manufacturing cost, and we have our variable marketing and admin cost. That's going to then equal our contribution margin. Then I subtract out my fixed costs, which is our fixed manufacturing costs and our fixed marketing and admin cost. And that will give me my operating profit. So let's look and see how this looks different. Our sales are not going to be any different. 2,370,000. Our variable manufacturing cost, the amount is not different. We just pulled that in. But now we're bringing in the variable marketing cost into the top section, which was 150,000. Sales minus all of our variable cost is going to give us our contribution margin. Then we're going to subtract out those fixed costs, which are given, to come down to our operating profit. I want you to notice that our operating profits do not change. All we're doing is moving things around for different decision making, which is what we're going to do for cost accounting.